comparative analysis of Australia's economic growth paths. We're looking at a country that was entirely built on traditional mineral exports, digging up iron and coal, that is now desperately trying to pivot.
Right, trying to shift toward emerging green energy services and entirely new global alliances. It's a phenomenal test case for anyone analyzing global markets right now.
It really is. I mean, we're watching a nation try to pull off this ultimate macroeconomic pivot in real time. The big question is, can they actually transition to a new model, or are they just going straight into a structural wall?
And to figure this out, we've brought together a pretty heavy-hitting stack of sources.
Yeah, we've got a really comprehensive compilation of economic analysis today. We're incorporating historical trade data plus the absolute latest projections straight through to early 2026.
Right, pulling from the Australian Bureau of Statistics, the Reserve Bank of Australia, the IMF, and the World Bank.
So pretty much the gold standard of data. And the goal here is to filter out the noise and give you the absolute core of what you need to know from all these conflicting viewpoints.
And the stakes here are just fascinating, especially when you consider the historical context. Because usually, when you analyze the economic history of the developed world, there is a strict expectation of boom and bust cycles.
Right. A decade of growth is inevitably followed by a market correction or a recession.
Exactly. It functions almost like economic gravity. But then you look at Australia, and that law of gravity just seems to vanish.
It's wild. We are talking about a nation that holds the global record for the longest continuous economic growth among developed nations. From 1991 all the way to 2020, they did not have a single recession.
Nearly 30 years of just uninterrupted expansion.
Yeah. So to understand the complexity of Australia's current puzzle, we first have to really understand that unprecedented economic wave they've been riding for the last 2 decades. Let's use the analogy of a surfer.
I like that.
For a very long time, Australia was kind of just sitting on the board, right? Just bobbing in the water, relatively isolated.
Yeah, and if we look at the pre-WTO era, so roughly 1978 up to 2001, Australia was indeed a relatively closed economy.
Right.
I mean, they had pushed through some major reforms in the 80s, like floating their currency and cutting tariffs, but it was mostly a very stable, quiet period.
And their mining sector back then was surprisingly small, right?
Oh, absolutely. The sector we now think of as this absolute behemoth was really modest. In the early 90s, mining contributed less than 5% to their total economic output.
Wow, less than 5%.
Yeah, they were mostly exporting wool, wheat, a bit of gold, mainly to traditional partners like the UK and Japan.
And their relationship with China during that period is almost unrecognizable compared to today. The data shows that historically, going all the way back to 1901, China accounted for less than 0.5% of Australia's goods trade.
0.5%? That's virtually non-existent.
Right. Even up to the year 2000, the trade connection was barely a blip on the radar. So, going back to our surfer, they're just sitting there waiting for a swell.
Yeah.
And then in 2001, China joins the World Trade Organization.
Now the water just starts pulling back.
Exactly. The biggest, most massive, once-in-a-century wave starts building on the horizon.
Because China's entry into the global trading system triggered this unprecedented era of rapid urbanization, we are talking about hundreds of millions of people migrating from rural farmlands into these massive, newly constructed megacities.
Because building entirely new skylines.
Right. High-speed rail networks, bridges, ports, at a scale the world had literally never seen before. And to build all of that infrastructure, China needed staggering, almost incomprehensible amounts of steel and concrete.
Which requires iron ore and metallurgical coal. And Australia just happened to be sitting on mountains of the stuff.
And positioned relatively close geographically, which is key. They caught the wave perfectly. The demand wasn't just large, it was explosive.
So how fast did their economy shift?
It was violent in its speed, honestly. Within just a few years, mining nearly doubled its share of the national GDP, up to like 8% by 2006. And we have to look at what economists call the terms of trade.
Okay, let's break that down for the listener.
Basically, this is the global purchasing power of what a country digs out of the ground versus what it imports. So suddenly, a single shipment of Australian dirt could buy vastly more imported electronics or cars or consumer goods than it could a decade prior.
Oh, wow. So they were just suddenly incredibly wealthy.
Exactly. This massive influx of wealth caused the Australian dollar to just surge in value.
Which brings us to the 2008 global financial crisis.
Yeah.
And this is where the wave essentially saves them.
Yeah.
The rest of the world's economy wipes out.
Utterly wipes out. Banks in the US and Europe are collapsing, housing markets are imploding, credit is completely frozen.
But Australia just glides right over the wreckage.
And the mechanism of that survival is really crucial to understand. When the 2008 crisis hit, China panicked about a global slowdown. So to keep their own economy from stalling out, the Chinese government launched a colossal domestic infrastructure stimulus package.
They just started building even faster.
Exactly. And that stimulus required even more steel, which meant a massive surge in demand for Australian iron ore. It triggered a historic mining investment boom in Australia.
We're like at tens of billions of dollars, right?
Try 130 billion Australian dollars by 2012, just pouring into the country to build new mines and railways, just to get the rocks onto the ships faster.
It's incredible. But I want to take that surfer analogy a step further. Because, riding that massive wave for so long had a real structural cost.
Oh, for sure.
If a surfer only ever uses their legs to balance on one specific type of wave for 20 years, the rest of their body suffers from muscle atrophy.
Right.
And in economic terms, this created what is known as a dual-speed economy.
That muscle atrophy is a brilliant way to conceptualize it. It's the Dutch disease effect. So the resource-rich regions, primarily Western Australia and Queensland, were running white hot. They were flush with mining cash, and wages in those sectors just skyrocketed.
But what about the rest of the country?
Well, the rest of the country, which relied on things like manufacturing or education, struggled immensely. Because that mining boom pushed the value of the Australian dollar so incredibly high, Australian manufactured goods became far too expensive for the rest of the world to buy.
So it basically hollowed out their domestic manufacturing base.
Exactly. They essentially let their other muscles weaken because they got very, very comfortable just digging things up and putting them on ships.
Which, to be fair, is highly profitable as long as the wave keeps rolling.
Right, as long as the wave holds.
But now, let's look at the 2026 macroeconomic snapshot. Because the wave is flattening out into shallow water.
The massive Chinese urbanization engine is stalling.
Yeah, and we have to see what happens to this post-pandemic economic structure. The data reveals an economy that is really bleeding momentum.
Yeah, the total economic output is still large, around 1.75 trillion Australian dollars, but the growth rate is slowing down significantly. The Reserve Bank of Australia models growth dipping from over 2% in 2025 down toward a really sluggish 1.6% as we approach 2027.
So there's a feeling of an engine losing RPMs.
Exactly. And the primary culprit dragging down those numbers is the exact same thing that propelled them in the first place: China's real estate sector.
Because China is undergoing this massive structural transition of its own, right?
Right. The RBA projects China's GDP growth at just 4.6% in 2026. They have reached a saturation point with infrastructure. The whole era of building ghost cities and endless apartment blocks is over.
They're trying to pivot their own economy toward high-tech manufacturing and domestic consumption.
Which models a direct, sustained, long-term decline in the demand for bulk steel, and by extension, traditional Australian iron ore.
Okay, I have to play devil's advocate here for a second.
Go for it.
Australia has navigated massive global shifts before. If Chinese iron ore demand is just slowly cooling off, why is this viewed as such a fatal threat to their long-term fiscal stability? Can't they just, adjust their export volumes and keep humming along?
It's a fair question, but the severity of the threat really comes down to the sheer concentration of risk. Currently, iron ore exports to China alone are valued at over 100 billion Australian dollars annually.
Wow, over 100 billion.
Just to China. That single trade flow is what props up government tax revenues, funds public services, and sustains the national surplus. If that revenue stream shrinks, the federal budget is facing a massive, massive hole.
That's terrifying.
But the real danger, the actual crisis, is that this international slowdown is happening at the exact moment Australia is fighting severe structural fires domestically.
Okay, yeah, let's unpack those domestic fires.
Yeah.
Because the data points heavily to this issue of sticky core inflation, which is peaking around 3.7% in mid-2026. And for you listening, core inflation strips out the volatile stuff like gas and groceries. When core inflation is sticky, it means the underlying costs of doing business, rents, services, domestic logistics, are just locked in an upward spiral.
Right. Even when global supply chains heal, it remains incredibly expensive to just operate domestically in Australia.
And adding fuel to that inflationary fire is a brutally high interest rate environment and a really severe domestic housing crisis.
Oh, the housing crisis is incredibly damaging because it directly restricts labor mobility. Think about it. If a new green energy industry opens up in South Australia, but workers literally cannot find or afford housing within 100 miles of the facility, the labor market freezes.
Right, you can't match the talent to the opportunity,
Precisely. And when you combine restricted labor mobility with that sticky inflation, you get plummeting productivity.
which the sources say is at its lowest growth since the 2010s, right?
Exactly. It is currently costing more capital and more labor to produce fewer goods. So their domestic engine is sputtering and misfiring right as the primary international growth engine, Chinese steel demand, is running out of gas.
So what does this complex shift mean for someone analyzing this from the outside? Say you are an international investor seeking long-term portfolio diversification.
Right.
To use a different analogy here, looking at Australia's historical setup is like an investor reviewing their retirement account, and they suddenly realize they are dangerously overweight in one highly profitable but increasingly volatile stock called Chinese Iron Ore Inc.
That's exactly what it is. And that single stock provided phenomenal dividends for 20 years, which allowed the investor to just ignore all other asset classes.
But the fundamentals of that company are permanently changing.
Right. So the investor desperately needs to rebalance their portfolio to mitigate that risk. They need to find steady mutual funds or, emerging sectors to offset those incoming losses in mining revenue.
And looking at the source data, the ultimate mutual fund offering stability in this scenario is actually the service sector.
Yes, the sheer dominance of the service sector is so often overshadowed by the sheer volume of dirt being moved in Australia. But services actually account for roughly 63% of Australia's total economic GDP.
63%.
Yeah. As the economy pivots, it has to transition from a pure resources boom model to a highly integrated resources plus services model. The service sector is the vital shock absorber for the entire economy here.
And we're seeing broad-based growth in financial, legal, and professional services. But the really fascinating part of the service export market to me is education and tourism.
Oh, absolutely.
Because, for someone not familiar with the terminology, it might sound kind of weird to call education an export since the student physically comes to Australia.
Right. But it functions exactly like an export because it brings foreign capital into the domestic economy. When an international student pays tuition at a university in Sydney or pays rent or buys groceries, that is new foreign money entering the Australian system.
And the resumption of these specific onshore exports, particularly from Asian markets like China, is a massive growth vector right now, currently sitting around 12.7 billion Australian dollars.
Exactly. And from an investor's perspective, focusing on risk management, the service sector offers a completely different geopolitical risk profile than physical commodities.
Right. It's way more insulated.
Significantly more insulated from geopolitical trade coercion. I mean, think back to the 2020 to 2024 period. Diplomatic tensions led to massive immediate tariffs on Australian physical exports. Things like wine, lobster, barley.
Yeah, because you can easily order customs officials to just block a physical crate of lobsters at a port.
Exactly. But it is exponentially harder for a government to blockade intellectual capital or stop businesses from seeking international financial consulting or, entirely suppress the desire of their middle class to seek international education. The barriers to entry for that kind of coercion are just much, much higher.
So services provide the stable baseline, the diversified mutual fund that keeps the portfolio from collapsing. But let's be real, Australia's undeniable natural advantage on the global stage is still what is buried into the dirt.
Oh, absolutely. They are a massive landmass with tiny population. The geology is still their primary competitive advantage.
Right, so the final piece of the economic puzzle isn't to stop mining entirely. It's changing what they mine and who they sell it to. We are looking at a full pivot from the old industrial economy to the new green economy.
Because the global economic paradigm is shifting, the world might need less bulk steel for Chinese apartment buildings, but the global green energy transition requires astronomical amounts of critical minerals.
We are talking about the lithium, the rare earths, the cobalt required to build electric vehicle batteries, wind turbines, massive renewable energy grids.
And Australia possesses vast, easily accessible reserves of all these critical minerals.
And if they manage this transition correctly, the potential growth trajectory is staggering. The projections outline a path where critical mineral exports could eventually scale up to fully replace the outgoing revenue from iron ore.
But it's not just about what they are mining, it's the geopolitical strategy driving who is buying it. The key term driving global supply chains right now is de-risking.
Yes, de-risking. Because Western nations have suddenly realized that relying on a single, potentially adversarial nation for the core components of their energy and technology grids is a massive security vulnerability.
Right, so we are seeing intense friendshoring
And
pressures.
let's just explain friendshoring really quickly for you listening. It's the intentional strategy of restructuring supply chains so that you only trade essential materials with countries that share your political and security interests.
Because you really don't want to wake up during a diplomatic crisis and find out your entire supply of battery materials has just been cut off by a foreign government.
Exactly. And this de-risking is being actively driven by major security alliances. You have AUKUS, right? The Trilateral Security Pact between Australia, the UK, and the US, which is heavily focused on sharing advanced technology.
And you also have the QOA Dialogue, a strategic forum between the US, India, Japan, and Australia. These aren't just military alliances anymore, they are fundamentally reshaping trade pathways.
Right. They view secure supply chains for critical minerals as a matter of literal national defense.
Which means Australia's trade partnerships are actively shifting. They are working hard to reduce that massive export reliance on China, which currently sits around 29 to 32%.
We're seeing major agreements like the Australia-India Economic Cooperation and Trade Agreement, the ECTA, which opens up access to India's booming consumer market.
And there's also a major pivot towards supplying the US market and the ASEAN nations.
Right, the Association of Southeast Asian Nations,
Yeah.
which represents a massive, rapidly industrializing bloc right on Australia's doorstep.
Exactly.
Okay, but I'll need to jump in with some major pushback here.
Okay, let's hear it.
Because Australia has been a mining superpower for over a century. They have the rocks, they have the sophisticated logistics networks, they have the deep water ports. It sounds great on paper to say, oh, we will just mine lithium instead of coal, refine it ourselves, and sell it to our friends in India and the US.
Right.
But why can't they just build the processing plants?
Yeah.
It seems like an incredibly obvious pivot. So why isn't this happening overnight? What are the actual structural barriers preventing them from doing this right now?
Well, because shifting from raw extraction to high-value processing requires an entirely different set of economic capabilities. Look, when you dig up raw lithium ore, you are essentially just moving dirt. It's heavy logistics. But the government's current critical minerals strategy aims to capture the high-value end of the supply chain by refining that rock locally before exporting it.
Right, they want to bake the cake instead of just selling the flour.
That's exactly the right framing. But refining lithium rock into, say, battery-grade lithium hydroxide is a highly complex chemical engineering process.
Okay.
It requires three critical inputs. You need massive capital investment to build the high-tech refineries. You need a highly specialized, skilled labor force to run them. And you need an enormous amount of cheap, reliable energy to generate the intense heat required for the chemical separation.
And this brings us crashing right back into the structural barriers we discussed earlier.
Yes. Australia is currently struggling with all three of those inputs. Their macroeconomic reality severely restricts their ambition right now. I mean, how do you attract the capital to build multi-billion-dollar processing plants when sticky inflation is driving construction costs through the roof?
You don't.
Right. And how do you staff those plants with specialized engineers when you have a severe housing crisis freezing labor mobility?
Right, they literally have nowhere to live.
Exactly. And perhaps most critically, Australia is currently dealing with significant energy transition issues of its own, meaning the cheap industrial power required for refining just isn't readily available.
So they are essentially in a race against their own internal economic friction. They have the raw materials the world desperately needs, but their domestic structural issues are acting as a massive handbrake.
But, and this is a big but, if the government policy can successfully cool inflation and reform housing to unlock labor and stabilize energy prices, the payoff is immense.
They don't just survive the decline of iron ore,
Right. They become a vital, irreplaceable node in the global green supply chain.
but if they fail to build that domestic processing capacity, what happens then?
If they fail, they remain merely a raw extractor. They will just dig up the lithium and ship it overseas for someone else to process and capture the profit. And that leaves them entirely exposed to global price shocks.
Because eventually, other countries will catch up, right?
Exactly. As countries in South America or Africa develop their own mineral reserves, the premium on Australian raw dirt will just vanish.
Yeah.
And that structural wall we talked about becomes completely unavoidable.
Man. So let's bring all these threads together for you listening. Australia is really standing at a truly historic macroeconomic crossroads. For 3 decades, they caught the ultimate wave, fueled by a unique cocktail of traditional mining and Chinese urbanization.
And that wave created unprecedented wealth, but it also masked some really deep structural vulnerabilities.
Exactly. And now, the wave is broken, and the old playbook simply won't work in the new environment. So for anyone analyzing global markets or looking for investment stability, the roadmap is becoming clear.
Right. The highest growth potential really lies in a successful execution of a three-pronged strategy. Transitioning raw extraction toward critical minerals, overcoming those domestic barriers to become a high-value processor in the green supply chain, and leveraging a robust, geopolitically resistant service sector to cushion the whole transition.
They have to rebalance their national portfolio, while actively mitigating the stark, undeniable risks of their historical over-reliance on a slowing Chinese economy. It is such a delicate balancing act of managing global geopolitics and domestic reform simultaneously.
It really is. They are paddling out into entirely new waters, and honestly, the whole world is watching to see if they can catch the next big swell.
Yeah. And as we conclude this analysis, we want to leave you with a final thought to mull over, something that builds on everything we've discussed today.
Think about the broader implications here. If Australia successfully manages this incredibly complex pivot, transforming from the world's quarry for industrial steel into the world's highly refined battery for renewable energy, how will that newfound leverage over vital technology supply chains completely redefine its geopolitical power and influence in the Indo-Pacific over the next 50 years?